welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is July 25th, 2023. It's a Tuesday, and markets have been up for about 12 sessions in a row. Presently, as we film this, if the Dow continues its winning streak, it's been the longest since about February of 2017. So that's a welcome sort of upside surprise this summer. But today we're going to talk about the sort of three topics that are moving markets and that could change that trend that we're seeing right now. The first topic would be the Fed's two-day meeting. It kicks off today. Tomorrow, we're going to get the conclusion of the meeting with the press conference, ultimately what the Fed's decision will be in terms of raising interest rates. We also got some key economic data we're going to discuss today about U.S. home prices as well as consumer confidence. Both of them are rising. Probably another reason as to why markets have been up as of late. And then contrarian investing, we're going to walk down that road and see how to position portfolios. But the U.S. home prices and consumer confidence rising. Some key data that came out today. Bottom line, in May, we got a month-over-month increase of 0.7% in terms of the U.S. home prices. They've increased. And the Case-Shiller measures show 1% increase. So both of them are back in positive territory, also showing signs of resiliency in the U.S. economy, i.e. even the consumer with a 7% handle on mortgage rates right now. One of the key reasons for that is basically limited inventory. Even though price adjustments have come down, there's still limited inventory because there's the lack of the trade-up. Ultimately, even if you have home equity in your home right now, your chances are you should or you most have a 3% mortgage. And so why would you trade out a 3% mortgage for a 7% mortgage? Because that's the prevailing market rate right now. So less people see the need to move right now for that trade up for a higher cost of living. And that's ultimately shrinking inventory and opportunities, and there's cash buyers still out there. Markets are moving, and that's pushing prices higher, which is very contrarian again as to where everyone said, wait, real estate's going to come down. Now, real estate's local, so if you look at sort of the Pacific Northwest, down 11% in prices. If you look at sort of even San Francisco and California, down 11% right now. So if you actually take a global look at sort of the Case-Shiller index, but in the Midwest, we're seeing a bid and a pickup, and even Florida is seeing a bid and pickup in terms of sort of housing, if you will. It's a supply and demand conversation there. Right now, as long as rents basically go a little bit higher, U.S. rents versus permanent job loss. The red line right here is the unit job loss pickups significantly. Rents can continue, or until the U.S. Job losses pick up significantly. Basically, we can still see this strong real estate market, and the U.S. rents have come down a little bit. This is what the Federal Reserve wants to see. Let me help us out there. So that trend in terms of rents, or basically the affordability index, is what the Fed is paying attention to. We need to see that come closer, meaning job losses. What they're looking for is they want that to continue. So let's talk about the U.S. Labor market. The U.S. consumer has helped the labor market because consumer spending is staying right in there. That's number one, hanging in there right now. That could fall off, but we're going to pay attention to it. So what we're looking at is high frequency data. One of the reasons why we look at strategists, because they basically take us a global market view of what's happening in the market, in the economy real time, because that translates into corporate balance sheets, earnings, i.e. if you will, and then the earnings tells the rest of the story, whether a company, even with higher input costs, think labor, think sort of supply chain issues early on, if they can still manage the bottom line. And a lot of corporations, as we're seeing the second quarter being reported right now, earnings are coming in quality better than expected. One, because they're managing the bottom line, and they're also doing inventory and cost reductions, and obviously labor in some particular cases. They're laying off or doing more with less, and that's helping the bottom line. And consumers are still hanging in there. U.S. confidence, consumer confidence, is sort of seen an uptick, as well as TSA. Here's the high frequency data. We know that part of the inflationary component, there's goods and services, what the Federal Reserve looks at. The services component is ultimately travel. And as you've seen, everyone's traveling this summer because of the last 3 years. It's been restrictive and clunky and really just prohibitive, if you will. So everyone's basically saying, hey, listen, let's get out there and do that family vacation. We did that earlier this summer as well, and it was a great experience, if you will. So you're seeing the pickup in services, i.e. travel, but that's not going to continue. I mean, that was a once, we took the family to Europe. That's not going to happen for maybe a good long time, maybe another 5 years. Who knows? Maybe my wife and I, but definitely not the kids, because it's definitely costly. But we had a wonderful time in doing it. So this is going to tail off at some point in time. That's what the Fed needs to see, as well as same-store sales are down. So consumers are spending. So the goods people aren't spending their time at home. And then buying the stuff from the stores. You're seeing that services dollar really pick up, goods and services, and that's the divergence there. So only small cracks in the U.S. labor market. This is the hours in the unemployment and quits, if you will. So the work week, the average work week is about 34 and a half hours per week. That's coming down. That means it's showing signs of pressure abating, if you will. U.S. jobs are easy to get but hard to find, if you will. It's one of the headlines that we're seeing. This isn't a jobless recovery. There's plenty of jobs out there, and then the quit rate you can see going down, but ultimately there's more small cracks in the U.S. labor market. Here's another one. This is the major one that we pay attention to, as does the Fed. It's the JOLTS opening, so job openings, if you will, and that's coming down, and that's exactly what needs to happen to reduce the pressure of wage inflation. Wage inflation is the anchor that the Federal Reserve really wants to basically get ahead of and make certain that it's not entrenched in the economy long term. And that's where they're going to be paying attention to. So how do we know this is the case? Also, not only the JOLTS reports, but the Indeed.com. Again, high frequency data. You can't just take one source and rely on it. You also use multiple sources to confirm sort of a trend or any economic macro information and data. And that's what we're doing here. Indeed.com started this in 2020, and that's ultimately just showing sort of that job posting indicator from that website. And that's also showing a downtrend here, which is the job openings. It's mirroring that, and it's matching that in terms of that trend. Again, that's relieving some of the tensions and pressures in the market itself. Now, no one would have guessed that the market's been up as much as it has, even up year to date. In fact, if you started if you go back to the chronicles and all the experts, the very last end of last year, the beginning of this year, a lot of people spoke that the market was going to be down for this year, and then there's always something out there that no one sees, either a positive upside surprise, which we received from technology and AI, and that's where it's giving a lift to a lot of the earnings that was unexpected in terms of the future anticipated earnings potential and the efficiencies within AI in a business all across sort of every sector in the U.S. economy, and you're seeing that play out as technology is up 30% year to date. And now there's laggards in the sort of S&P sectors. You're thinking energy. Energy had its run a few years back, and it's sort of cooling off in negative year to date. Financials are negative year to date, if you will, but starting to see a bid. And those two last, industrials as well as materials. And so there's sort of a contrarian effect here that we're seeing. But that's why you have to stay balanced and diversified. We're selling and trimming some of our large cap growth positions, and we're buying some of the positions that are, again, out of favor. Utilities we're going to lay off on, but there's healthcare, compelling stories in healthcare. Materials we really like. Energy, we're seeing some opportunities there, as I've talked about before. So the bottom sector have from a price to earnings standpoint, and this is from May 31st of 2023. If you look at the energy sector, less than a 10% PE ratio, price to earnings ratio. Historically, you're looking at a 17% on the S&P 500 if you look at all sectors combined. Right now, you're looking at a 25% PE ratio on technology, so it's overvalued. So we want to trim an overvalued price to earnings, sort of that's a measure of terms of how something is priced. Is it over or undervalued? We like selling into the strength, and we've been doing that, but rebalancing. And we're rebalancing into the energy sectors or sectors that are dividend growth on the value side all across the spectrum here, because value really hasn't played a role, or even industrials haven't played a role, and even half of the S&P 500 hasn't played a role, such as value investing or dividend paying stocks. They've been lagging. But keep in mind, since 1925, why we like dividends, you have to be patient with dividends and dividend growth companies, is because 39% of the total return of the S&P 500 dating back to 1925, it can be attributed to that dividend cash flow. It also is a confirmation. Let's say we get into an earnings recession at some point in time. We haven't seen it this quarter, but maybe a couple quarters down, maybe heading into 2024, as maybe the economy slows, we will look into corporate balance sheets for quality. And again, you can't fake a dividend if you're a corporation. So value plays a role, rebalancing is key, and that's what we're doing for our clients right now. So if you see on your statement, the growth companies have taken, a shot up of 30, 40, 50%. We've seen a lot of that year to date. Clients are happy. But you also see the value hasn't been up, maybe less than 10% year to date. And you're like, hey, what's going on? Why wouldn't we put all our eggs in one basket? And that's exactly what you don't do when you're investing, and investing for the long run. So you got to be patient. You have to be long-term view, and you have to buy stuff that's out of favor, a contrarian point of view, and balance, and just stay on top of it. That's the key here. That's what we do for our clients at Blanke, Schein Wealth Management. Thanks for watching today's edition, and make sure you stay cool. It's about 118 degrees here in the Palm Desert, California area, but I know it's hot everywhere. So thanks for watching. We'll catch you again next time.